There is a ghost in the machine of modern investing. It's a phantom that haunts every portfolio, a whisper in the ear of every person who has ever put $1 into the stock market. It's not the fear of buying the wrong company or the anxiety of a market crash. It's a far more subtle and insidious force, one that attacks not at the point of purchase, but at the moment of perceived success. It's the impulse, the overwhelming urge to sell. We spend 99% of our time, our research, our energy, trying to answer a single question: what should I buy? We read books, we watch videos, we analyze charts, all in the hunt for the next great investment. But the man who solved the investing puzzle, Warren Buffett, understood a deeper truth. He understood that the amateur's obsession is only half the equation, and it's the less important half. The true mastery, the secret that separates the generational fortunes from the fleeting gains, lies in answering the much harder question: when should I sell? The answer, for Buffett, is as simple as it is profound: almost never. His philosophy, famously summarized as, quote, "our favorite holding period is forever," is not a folksy platitude. It is a weapon. It is a carefully engineered financial discipline, designed to be a direct antidote to the hyperactive, emotionally driven, fee-generating culture of modern finance that urges us to trade, to churn, to take profits, to cut our winners and let our losers run. This is not a guide on how to find the next hot stock. This is a journey into the mind of the master, a deconstruction of the operating system that governs the final, most critical decision in the entire investment process. We will dissect the 3, and only 3, scenarios that can force Buffett's hand. First, when the business itself, the castle he bought, has had its competitive walls breached and its future is no longer secure. Second, when an opportunity arises that is so overwhelmingly superior to a current holding that the switch is mathematically undeniable. And third, when the market, in a fit of manic euphoria, offers a price for a business that is so absurdly, fantastically high that to not sell would be an act of financial negligence. This is the blueprint for turning investing from a casino game of guessing stock prices into a disciplined practice of owning great businesses. It is the cure for the costly disease of premature profit-taking. It is the key to unlocking the single most powerful force in the universe for wealth building: the uninterrupted, untaxed, unbelievable magic of long-term compounding. This is the final promise of value investing. Our journey begins not with a stock, but with a box of chocolates. To understand the forever mindset that underpins all of Warren Buffett's selling decisions, you have to understand that he doesn't think in terms of ticker symbols or quarterly earnings beats. He thinks in terms of owning businesses, whole and entire, as if he were a private owner who had inherited a family company. This philosophy was not born in a classroom. It was forged in the fires of experience, and no experience was more formative than the acquisition of See's Candies in 1972. At the time, Berkshire Hathaway was a far cry from the behemoth it is today. Buffett and his partner Charlie Munger were on the hunt for wonderful businesses at fair prices. Through a contact, they were introduced to the See family, who were looking to sell their beloved California-based candy company. The business was a gem. It had a fanatically loyal customer base, a powerful brand that commanded pricing power, and a simple, understandable model. Customers happily paid a premium for the quality and nostalgia associated with a box of See's. The numbers were just as sweet. The company was earning about $2 million after tax and required very little capital to operate, meaning it gushed free cash. The asking price was $30 million. Buffett and his associate Rick Guerin did the math. The business had tangible assets, book value, of only about $8 million. Paying $30 million meant they were paying a $22 million premium for the intangible assets, the brand, the customer loyalty, the goodwill. At the time, this was a huge conceptual leap for Buffett, who was still deeply rooted in the, quote, cigar butt investing school of his mentor, Ben Graham, which focused on buying statistically cheap companies, often for less than their net assets. Paying a massive premium for an intangible brand felt speculative. He offered $25 million. The C family, resolute, held firm at $30 million. Buffett, reluctant to pay what he saw as such a steep price, walked away. The deal was dead. This is where the story could have ended, becoming just another footnote of a missed opportunity. But Charlie Munger stepped in. Munger, unlike Buffett, had a much deeper appreciation for the qualitative aspects of a business. He understood that a powerful brand and pricing power were assets just as real as a factory or a machine, and often far more valuable. He relentlessly pushed Buffett, arguing that a truly great business was worth a premium price. To let a company like C's slip away over a few $1 million, he argued, was a monumental error. We were buying a business that was going to be churning out cash for decades, Munger would later reflect. The extra $5 million was going to be meaningless over the long run. Persuaded by Munger's logic, Buffett relented. He went back to the C family and paid the $30 million, though his partner Rick Guerin dropped out, unwilling to meet the price. The acquisition was completed, and for the first time, Berkshire Hathaway owned 100% of a truly wonderful business. And then, they did nothing. They didn't look for a greater fool to sell it to in 3 years. They didn't try to time the market. They didn't worry about the next recession. They simply acted as owners. They kept the management in place, nurtured the brand, and each year, they collected the cash the business generated. That initial $30 million investment, the one Buffett almost walked away from, has since produced over $2 billion in pre-tax earnings for Berkshire Hathaway. All of that cash was sent to Omaha to be redeployed into other investments, funding the growth of the entire Berkshire empire. C's Candies became the prototype. It was the experience that taught Buffett and Munger that it was, in their words, far better to buy a wonderful company at a fair price than a fair company at a wonderful price. More importantly, it taught them the immense power of owning a business you never want to sell. It crystallized the forever mindset. When you buy a business with the intention of holding it forever, your entire analytical framework shifts. You stop asking, what will the stock price do in the next 6 months? And you start asking, will this business be earning more money and be more competitively dominant in 10, 20, or 50 years? This simple shift is the foundation of all that follows. It is the reason selling becomes such a rare and momentous event, because you only buy something in the first place if you believe its long-term trajectory is so strong that the idea of parting with it seems foolish. The C's Candies story is the foundational anecdote because it wasn't a stock purchase. It was a business acquisition that rewired Buffett's brain and laid the psychological groundwork for a holding period measured not in years, but in generations. The power of this forever mindset isn't just a quaint business philosophy. It's a sophisticated psychological hack that insulates an investor from the most destructive cognitive biases that plague the human mind. The primary principle at play here is a powerful combination of commitment and consistency bias and the endowment effect. Commitment and consistency is our deep-seated psychological need to be consistent with things we have already said or done. When you make a decision or a commitment, you feel an internal pressure to stick with it. By framing a stock purchase not as a speculative bet, but as a, quote, commitment to permanently own a piece of a business, you trigger this bias to work in your favor. You are no longer a trader looking for a quick exit. You are an owner, and owners are supposed to be consistent and loyal. This simple mental reframing creates a powerful inertia against selling. The second force, the endowment effect, is the well-documented phenomenon where people ascribe more value to things merely because they own them. In a famous experiment, participants were given a coffee mug and then offered the chance to sell it. The price they demanded to sell their mug was consistently double the price other participants were willing to pay to acquire the exact same mug. Ownership itself creates an emotional bond that inflates perceived value. For the average investor holding a mediocre stock, this is a dangerous bias that leads to holding on to losers. But when you combine it with the discipline of only buying wonderful businesses in the first place, the endowment effect becomes a powerful shield. It makes you naturally reluctant to part with your high-quality assets. You value your stake in a great company more highly, precisely because it's asterisk yours, which helps you resist the temptation to sell it for a trivial reason, like a small gain or a scary news headline. These two biases work together to counteract the siren song of short-termism, which is primarily driven by what psychologists call the availability heuristic. This is our tendency to overweight the importance of recent events and information that is easily available. The daily news, the talking heads on financial television, the red and green flashes of a stock ticker. This is all highly available information. It screams for our attention and urges us to react. The availability heuristic is why a scary headline about a potential recession can cause someone to sell a wonderful business they had planned to own for 20 years. The immediate, available threat of a price drop overrides the long-term, abstract promise of compounding. The forever mindset acts as a bulwark against this. By committing to permanent ownership, you are pre-deciding to ignore the noise. You are telling your brain that the daily fluctuations are irrelevant to your long-term business plan, thereby defanging the availability heuristic. It's a conscious choice to prioritize the long-term business reality over the short-term market narrative. This psychological shift is the difference between being a passive reactor to market whims and a proactive owner of productive assets. Translating this powerful psychology into a practical, repeatable process is the key to making it work for your own financial discipline. The mental model to apply here is what we can call the private business owner test. It's a series of mental exercises designed to force you out of the mindset of a stock picker and into the mindset of a true proprietor. The first step is to apply this test before you even buy. Find the company you're interested in. Now, get a piece of paper or open a new document and write this sentence at the top. I am buying the entire XYZ Corporation for its current market capitalization of, insert the full market cap, e.g., $500 billion. And I am accepting a condition that I will be legally forbidden from selling this business for a minimum of 10 years. Now, sit with that. Does the investment still make sense? This single exercise changes everything. It forces you to look past the per-share price and grapple with the true cost of acquiring the entire enterprise. It eliminates the seductive idea that you can just bail out if things get a little rocky in the next quarter. You are forced to evaluate the durability of the company's competitive advantage, the quality of its management, and its long-term growth prospects with a level of seriousness that a quick trade mentality never requires. If you can't honestly say you'd be comfortable with that 10-year lockup, you shouldn't be buying the stock for a 10-minute hold. The second step of the test happens after you've made a purchase. Instead of tracking your new holding on a stock app, create what you might call a business owner's brief. This is a one-page document where you summarize the business you now partially own. It should include sections on its primary products or services, its key management personnel, its top 3 competitors, and, most importantly, what you believe its primary competitive advantage is. Review and update this brief once a quarter. This act of writing and reviewing forces you to engage with the business fundamentals, not the price fluctuations. Imagine you inherited a local restaurant from a beloved uncle. You wouldn't value it by getting a new quote every second of every day. You'd focus on the quality of the food, the happiness of the customers, the profitability, and the local competition. The business owner's brief forces this same rational perspective onto your stock market holdings. The third and final step is a daily mental habit. When you see your stock's price move, either up or down, consciously tell yourself, that is not my business. That is simply the moody, irrational price Mr. Market is offering for my business today. This technique, borrowed directly from Buffett's mentor, Ben Graham, personifies the market as a manic-depressive business partner. Some days he's euphoric and will offer you a ridiculously high price for your shares. Other days he's despondent and will offer to sell you his shares for pennies on the dollar. You are under no obligation to transact with him. By framing the daily price quote as merely an offer from an unstable partner, you emotionally detach from its volatility. You remain the calm, rational owner, focused on the long-term operational performance of your company, not the fleeting mood swings of the marketplace. This complete mental model, the pre-purchase commitment, the post-purchase brief, and the daily detachment, is the practical blueprint for instilling the forever mindset. To truly appreciate the wisdom of this approach, we must examine its opposite. We must walk the well-trodden path of the 99%, the path of the ticker symbol gambler. This individual does not see themselves as a part owner of a complex enterprise. They see a stream of data, a ticker symbol like APPL or TSLA, attached to a flickering number that is either green or red. Their entire reality is detached from the underlying business. They don't know who the CEO is, what the company's profit margins are, or what its return on invested capital looks like. Their world is the chart, the price, the momentum. The gambler's cycle is tragically predictable. It begins with a hot tip, perhaps from a friend, a financial news channel, or a social media influencer. A story about a revolutionary technology or a paradigm-shifting product ignites a powerful sense of FOMO, the fear of missing out. They jump in, buying the stock at a price that is often already inflated by the hype. For a while, it works. The price goes up. They feel like a genius. But then comes the first crucial error. After a 20 or 30% gain, a new feeling emerges, the fear of giving the profits back. The voice of conventional wisdom whispers, "You can't go broke taking a profit." So they sell. They lock in their small gain, feeling clever and prudent. What they have actually done is cut one of their flowers. They have sold a potentially great long-term compounding machine for a pittance of its future worth. Let's imagine this gambler bought shares in a dominant company like Microsoft in 2013 for around $30 a share. By 2015, the stock had risen to over $50, a handsome gain of more than 60% in 2 years. The ticker symbol gambler, congratulating himself on his savvy trade, sells his entire position to take the money off the table. He successfully turned $10,000 into $16,000, but in doing so, he forfeited the subsequent journey to over $400 a share. His $16,000 victory cost him a potential $400,000 fortune. The other side of the gambler's coin is how they handle downturns. When a stock they own goes down, they don't consult their business owner's brief because they don't have one. They don't analyze whether the fundamental business is still intact. They only see the red number, and it triggers a powerful sense of loss aversion. Their new mantra becomes, "I'll just wait for it to get back to even, and then I'll sell." This is the hopeful bag holder's prayer, a complete abdication of investment strategy. Their capital becomes trapped in a deteriorating asset, not because of a rational belief in its future, but because of an emotional aversion to realizing a loss. This entire approach, a portfolio management strategy driven by the twin emotions of fear and greed, leads to a constant churning of the account. The gambler is always busy, always trading, always reacting. They sell their winners too early and hold their losers too long, the exact inverse of a sound investment strategy. Their portfolio becomes a garden where the flowers are constantly plucked before they can bloom, and the weeds are watered with hope and stubbornness until they consume all the soil. This is the path of the 99%, a path of high activity, high fees, high taxes, and ultimately low returns. It is the direct antithesis of the patient, disciplined, business-like ownership model that Buffett has perfected. The financial consequences of adopting the forever mindset versus the ticker symbol gambler's approach are not small, they are monumental, a difference that can define the line between modest savings and true financial freedom. The divergence in outcomes is driven by two of the most powerful forces in finance, the magic of uninterrupted compounding and the tyranny of tax drag. Let's quantify this with a clear example. Imagine two investors, Investor A, the owner, and Investor B, the gambler. Both start with a $10,000 investment in a wonderful business that is set to grow its intrinsic value, and thus its stock price, at an average rate of 15% per year for 30 years. Investor A, our Buffett disciple, buys the stock and does nothing. She holds it for the full 30 years, never selling. Her $10,000 compounds at 15% annually without interruption. The math is straightforward. At the end of 30 years, her initial $10,000 has grown to $662,117. It is a testament to the explosive power of letting a great investment run. Now consider investor B, the ticker symbol gambler. He invests in the same great company, but he is a tinkerer. He gets nervous during downturns and euphoric during upswings. Every 3 years, he sells his position to lock in his gains and then, after feeling clever for a while, buys back into the same company. For simplicity, let's assume the price is the same. However, each time he sells, he has to pay taxes. Let's assume a modest long-term capital gains tax rate of 20%. After the first 3 years, his $10,000 has grown to $15,209. He has a gain of $5,209. He sells. He must pay 20% of that gain in taxes, which is $1,042. He is now left with $14,167 to reinvest for the next 3-year cycle. He repeats this process every 3 years for the 30-year period. He feels like he's actively managing his money, being prudent by taking profits. But what is the final result? At the end of 30 years, Investor B's portfolio is worth only $326,464. That's less than half of what Investor A accumulated. Let that sink in. The exact same starting capital, the exact same investment vehicle, the exact same underlying growth rate. The only difference was the decision to hold versus the decision to trade. The ticker symbol gambler gave away over $335,000, more than his final net worth, to taxes and lost compounding. Buffett understands that a capital gains tax is a direct levy on your compounding engine. Every time you sell a winner, you are inviting a silent partner, the government, to take a significant cut of your profits. That money is then permanently removed from your portfolio, unable to grow and compound for you in the future. The forever holding period is therefore not just a philosophy. It is a profoundly effective tax deferral and wealth-building strategy. By refusing to sell, you are keeping 100% of your capital working for you, year after year, decade after decade. You are allowing the compounding machine to run at its maximum, uninterrupted speed. This direct financial connection is the mathematical proof behind the mindset. The goal is not to have a portfolio of small, realized gains. The goal is to own a collection of wonderful businesses and to allow their value to compound to staggering heights over a lifetime, with the tax bill deferred as far into the future as possible. That is how true wealth is built. Even with the firm intention to hold forever, there are rare circumstances when a sale is not only justified but necessary. The first and most important of these reasons is the erosion of a company's durable competitive advantage, what Warren Buffett famously calls its, quote, economic moat. The perfect story to illustrate this painful but necessary decision is not one of Buffett's celebrated victories, but a tale of his slow, reluctant retreat from an industry he once loved: newspapers. For decades, Buffett viewed the newspaper business as the ultimate economic castle. In the pre-internet era, a town's dominant newspaper was a fortress. It had an unregulated monopoly on information, advertising, and community connection. If a local citizen wanted to find a job, buy a car, rent an apartment, or see a movie time, they had to go through the local paper. This gave these businesses incredible pricing power and astonishing returns on capital. In 1973, Buffett made one of his most brilliant investments, buying a large stake in the Washington Post Company. Under the brilliant leadership of Katharine Graham, the Post was a franchise of the highest order. Buffett paid about $10 million for his stake. Over the next 30 years, that investment would grow to be worth over $1 billion. He loved the business, he admired the management, and he understood its impenetrable moat. He even bought his hometown paper, the Omaha World-Herald, as part of his larger newspaper empire. He wrote in his 1991 letter to shareholders, An economic franchise arises from a product or service that is needed or desired, is thought by its customers to have no close substitute, and is not subject to price regulation. The possession of all three characteristics is rare, but when they are present, the financial results can be extraordinary. The newspaper business for a long time checked all three boxes, but then a new technology began to emerge, a dragon that would lay siege to these once impenetrable castles: the Internet. At first, its effects were subtle, but by the early 2000s, the writing was on the wall. Craigslist began to eat away at the lucrative classified advertising section. Real estate listings moved to Zillow. Car sales moved online. News itself became a free commodity, available from thousands of sources, instantly. The newspaper's moat was not just being breached, it was being systematically dismantled. The product was no longer seen as having no close substitute. Buffett, a man who prides himself on his ability to see the long-term trajectory of a business, watched this happen with a clear eye. Despite his deep personal and emotional attachment to the industry, he began to speak about it in his shareholder meetings. In 2006, he remarked that the industry had gone from monopoly to franchise to competitive. By 2009, his language was even starker, stating that the fundamentals of most newspapers were in an unending decline. The evidence was undeniable. Circulation was plummeting, advertising revenue was collapsing, and the once mighty profit margins were vanishing. The core business thesis that had made them such a brilliant investment for 50 years was now broken. And so, with a heavy heart but a clear mind, he acted. Starting in the late 2000s and continuing over the next decade, Berkshire Hathaway systematically sold off its entire portfolio of newspaper holdings, including the sale of the Omaha World-Herald in 2020. He was not selling because the stock prices were down. He was selling because the businesses themselves were broken. The castle was no longer defensible. This painful saga is the ultimate masterclass in selling discipline. It demonstrates the ability to separate emotional attachment from rational business analysis and to act decisively when the fundamental, long-term prospects of a company have irreversibly deteriorated. The decision to sell a beloved, long-held investment due to business deterioration is one of the hardest things for an investor to do, because it forces you to confront two of the most powerful and insidious cognitive biases: the sunk cost fallacy and confirmation bias. The sunk cost fallacy is our tendency to continue with an endeavor if we have already invested significant time, money, or effort into it, even when it's clear that the current prospects are poor. The thought process is, I can't sell now, I've already held it for 10 years, and it used to be such a great company. The past investment of time and capital feels like it must be justified by continuing the course, even if that course leads off a cliff. Selling would be an admission that the past decade of holding was, at least in its final years, a mistake. Buffett's sale of his newspaper empire was a direct triumph over this fallacy. He had invested not just money but decades of his intellectual and emotional capital into understanding and championing the industry. Yet he was able to recognize that those past costs were sunk and irrelevant to the future. The only question that mattered was, if I had the cash in hand today, would I reinvest it into this business? When the answer became a clear no, he knew he had to act, regardless of the sunk costs. The second, related bias is confirmation bias, which is our natural tendency to seek out, interpret, and favor information that confirms our pre-existing beliefs. If you believe, as Buffett once did, that newspapers are wonderful businesses, you will subconsciously look for evidence that supports this thesis. You'll focus on a small uptick in online subscribers, while ignoring the catastrophic collapse in print advertising. You'll listen to the CEO's optimistic turnaround plan while discounting the objective market share data. Confirmation bias builds a comfortable reality bubble around our cherished beliefs, and it is a formidable enemy of objective analysis. Buffett's genius lies in his brutal intellectual honesty. He actively seeks out disconfirming evidence. He constantly asks himself and his managers, what are the biggest threats to this business? How could we fail? This process of actively trying to poke holes in his own thesis allowed him to see the threat of the internet to his newspaper holdings far more clearly and earlier than his emotionally invested peers. He didn't let his past success or his affection for the industry blind him to the new, unpleasant reality. Overcoming these twin biases is what separates professional capital allocators from amateur hopeful bagholders. It requires the humility to admit when a past decision is now wrong and the courage to act on that new information, even when it's emotionally painful. The sale of a deteriorating business isn't an admission of failure. It's the pinnacle of investment discipline. To avoid becoming a victim of these biases, you need a systematic, unemotional way to monitor the health of your company's moats. You need to build what we can call the moat monitoring system. This is not a complex financial model, but a disciplined process of qualitative and quantitative review. The first step happens at the moment of purchase. Before you invest a single dollar, you must explicitly write down the 3 to 5 specific factors that constitute the company's economic moat. Be precise. Don't just write brand. Write a powerful brand that allows the company to charge a 20% price premium over its nearest competitor for a similar product. Don't just write network effect. Write a dominant social network where the value for each user increases with the addition of every new user, creating prohibitive switching costs for its 2 billion members. This act of defining the moat in specific, measurable terms at the outset is your foundation. It gives you a clear baseline against which you can measure all future developments. The second step is to create a recurring review process. On a quarterly or semi-annual basis, you must revisit your initial moat thesis and actively challenge it. This is not a passive reading of the earnings report. This is an active search for disconfirming evidence. Your checklist should include questions like, are the company's gross profit margins increasing or decreasing? If they are decreasing, is it due to temporary factors or a new, low-cost competitor? Is the company gaining or losing market share? What are its primary competitors saying about them in their own conference calls? Are new technologies emerging that could render this company's product or service obsolete in the next 10 years? You are acting as a corporate detective, looking for cracks in the castle walls. The third and most critical step is to pre-commit to kill criteria. Before emotion enters the picture, you need to define what specific evidence of moat erosion would automatically trigger a sale. For example, you might write, if the company loses its #1 market share position in its core product category for 2 consecutive years, I will sell the entire position. Or, if a new technology emerges that can deliver a similar benefit to the customer at half the price, and my company fails to develop a competing product within 18 months, I will sell. These predetermined rules are your tripwires. They are designed to force your hand when your future self might be tempted by hope or paralyzed by loss aversion. By setting the rules of the game when you are calm and rational, you protect yourself from making emotional, in-the-moment decisions when you are under pressure. This moat monitoring system, defining the moat, actively challenging the thesis, and pre-committing to kill criteria, transforms the decision to sell from a gut-wrenching emotional guess into a disciplined, logical process. It's how you ensure you sell for the right reasons, because the business has changed, not because the stock price has flickered. Failure to implement such a system leads an investor down the sorrowful path of the hopeful bagholder. This is the person who confuses the price they paid for a stock with the ongoing value of the business. Their portfolio becomes a museum of once great companies that have fallen on hard times. Their decision-making is anchored not to future prospects but to a historical data point, their purchase price. A classic, painful example of this is the story of investors in Research in Motion, the maker of the BlackBerry. In the mid-2000s, BlackBerry was a fortress. Its moat was built on secure enterprise servers, a beloved physical keyboard, and a network effect through its BlackBerry Messenger service. It was the must-have device for business and government, but then, in 2007, a disruptive technology emerged, the Apple iPhone. The hopeful bagholder who owned BlackBerry stock might have initially dismissed it. It doesn't even have a keyboard, they would scoff. Business users will never use a touchscreen. This is confirmation bias at work. As the iPhone and then Android devices began to rapidly gain market share, the evidence of BlackBerry's moat erosion was overwhelming. Their profit margins collapsed as they were forced to compete on price. Their once unassailable enterprise security was matched by competitors. Their BBM network effect was rendered obsolete by cross-platform apps like WhatsApp. The fundamental business thesis was shattered, yet countless investors held on. A person who bought BlackBerry at its peak of over $140 a share in 2008 watched it plummet. At $70, they told themselves, it's been cut in half, it's cheap now, it has to come back. At $30, they said, I've lost too much to sell now, I'll just hold on and hope for a turnaround. At $10, they were paralyzed, holding a tiny fraction of their original investment, their capital trapped in a melting ice cube. They weren't holding because they had done a fresh analysis and concluded BlackBerry was the best place for their money going forward. They were holding because they were emotionally anchored to their high purchase price and couldn't bear to crystallize the massive loss. They were watering a dead weed, hoping it would miraculously reblossom. The same story played out for investors in Blockbuster who ignored the rise of Netflix, or Sears, who ignored the rise of Walmart and Amazon. The hopeful bag holder ignores the evidence of fundamental business decay and instead clings to the hope that the stock price will somehow recover to their break-even point. This is not an investment strategy, it's a prayer. It violates the most basic rule of portfolio management. Your capital should always be deployed in the opportunities with the best future prospects, not held captive in the prisons of past mistakes. The direct financial consequence of holding onto a business with a deteriorating moat is the collapse of its ability to generate wealth. The single most important metric for understanding a company's long-term value creation potential is its return on invested capital, or ROIC. This number tells you how much profit a company generates for every dollar of capital it invests in its operations. A business with a wide, durable moat, like See's Candies in its prime, can consistently invest capital at very high rates of return. Let's say a company has an ROIC of 20%. This means for every $100 million, it reinvests back into the business, building new factories, marketing, research and development. It generates an additional $20 million in annual profit. This is a powerful compounding machine. When a company's moat begins to erode, competition rushes in. New rivals force the company to lower its prices, increase its marketing spend, and invest more in R&D just to keep up. The financial result is a swift and often brutal decline in its ROIC. The company might now have to invest $100 million just to generate an extra $5 million in profit, an ROIC of only 5%. This is a mediocre business, one that earns a return barely above its cost of capital. Let's see how this plays out on the balance sheet and for the shareholder. Company A, the Fortress, has a strong moat and a sustainable 20% ROIC. It earns $1 billion in profit this year and decides to reinvest half of it, $500 million, back into the business. Thanks to its 20% ROIC, that $500 million investment will generate an additional $100 million in profit next year. Its earnings will grow by 10%, from $1 billion to $1.1 billion. The business is becoming more valuable at a rapid clip. Now consider Company B, the crumbling castle. Its moat is under attack. It also earns $1 billion and reinvests $500 million. But its ROIC has fallen to a paltry 5%. That $500 million investment will only generate an additional $25 million in profit next year. Its earnings will only grow by 2.5%. The market sees this. Investors are not willing to pay a high price for a business that can no longer compound capital effectively. The stock's price-to-earnings multiple will contract, and the stock price will stagnate or fall, even if the company isn't losing money. The decision to sell a company whose moat is in terminal decline is not an act of market timing. It is an act of capital preservation and reallocation. It is the recognition that the business has lost its ability to compound your wealth at an acceptable rate. By selling, you are freeing up that capital to be redeployed into a new fortress, a company that can once again earn high returns on capital and restart the powerful compounding process. Holding onto the crumbling castle is a guarantee of mediocre returns, a financial sinkhole that drains your portfolio's potential. The second legitimate reason to sell a stock, according to the Buffett doctrine, is a far more offensive and opportunistic maneuver. It occurs when you find a new investment that is so dramatically superior to one of your current holdings that the switch becomes a mathematical imperative. This is not about selling a good company to buy a slightly better one. The bar is exceptionally high. It's about having the discipline to hold on to your solid performers until you are presented with what a poker player would call an unbeatable hand. A perfect illustration of this principle in action was Buffett's capital allocation during the absolute depths of the 2008 financial crisis. As the global financial system teetered on the brink of collapse, fear was rampant. Most investors were selling everything indiscriminately, desperate to raise cash. Buffett, however, was on the hunt. He had billions in cash ready to deploy, and because of the widespread panic, he was in a position to name his price. In September 2008, with Lehman Brothers having just collapsed, the venerable investment bank Goldman Sachs was facing a crisis of confidence. They needed capital, and they needed the ultimate stamp of approval to calm the markets. They called the one person who could provide both: Warren Buffett. The deal they struck was legendary. Berkshire Hathaway invested $5 billion into Goldman Sachs. But this wasn't a simple stock purchase. Buffett negotiated for $5 billion worth of preferred stock that paid him a staggering 10% annual dividend. That's $500 million in cash delivered to Berkshire every year, guaranteed. As if that wasn't enough, he also received warrants that gave him the right to buy another $5 billion worth of common stock at a fixed price of $115 per share, exercisable at any time in the next 5 years. This was the unbeatable hand. He was getting paid a fortune to wait, and he had massive upside potential if the bank recovered. A few weeks later, he struck a similar deal with General Electric. Then, in 2011, with markets still nervous about the banking sector, he made another landmark investment in Bank of America, investing $5 billion in preferred stock that paid a 6% dividend, and he once again received warrants with enormous upside potential. To fund these and other opportunities, Buffett had to be a seller of something. He strategically trimmed positions in less compelling investments that did not offer the same asymmetric risk/reward profile. He wasn't selling his core holdings like Coca-Cola or American Express, but he would sell other, less attractive assets on the periphery of his portfolio. The key insight here is that the decision to sell was not driven by any problem with the company being sold. It was driven entirely by the overwhelming superiority of the new opportunity. He sold a B-plus investment to fund an A++ investment that was available for a limited time due to market panic. This is the essence of opportunistic selling. It requires the mindset of a portfolio manager who sees every holding not in isolation, but in constant competition with every other potential investment in the universe. Your money should always be in the place where it can work hardest for you, and sometimes that means selling a perfectly good business to seize a truly extraordinary one. The psychological discipline required to act like Buffett in this scenario is immense, as it forces you to combat a subtle but powerful cognitive bias: opportunity cost neglect. Opportunity cost is the value of the next best alternative that you give up when you make a choice. Every day that you choose to continue holding a stock, you are implicitly making a decision to sell it and invest that money somewhere else. The cost of that somewhere else is the opportunity cost. Most people are terrible at thinking this way. They evaluate their investments in a vacuum. They ask, is my Johnson & Johnson stock still a good company? If the answer is yes, they continue to hold it out of sheer inertia, a phenomenon known as the status quo bias. We prefer for things to stay the same, and it takes a significant activation energy to make a change. Buffett's brain is wired differently. He is a master of fighting the status quo bias by constantly thinking in terms of opportunity cost. He is not asking, is Johnson & Johnson a good company? He is asking, is holding Johnson & Johnson today the absolute best, most profitable use of this capital compared to every other investment opportunity available to me in the entire world? It's a much harder and more demanding question. It forces him to actively compare his current holdings against new ideas. He sees his portfolio not as a static collection of past decisions, but as a dynamic pool of capital that must constantly re-justify its existence. During the 2008 crisis, while others were thinking, my regional bank stock is a good company, I'll just hold on through this, Buffett was thinking, the opportunity cost of holding this regional bank, which might earn me 8% a year if it recovers, is a guaranteed 10% dividend from Goldman Sachs plus warrants worth billions. The choice is obvious. By constantly framing his decisions in this way, he forces a rational, competitive evaluation. He overcomes the emotional attachment and inertia that keeps most people locked into merely good investments, freeing him to move decisively when a great one appears. This is a mindset shift from a passive stock collector to an active capital allocator. The stock collector acquires shares and holds them. The capital allocator understands that their job is to ensure every single dollar is working in its highest and best use at all times, even if that means selling a long-term holding to do so. To operationalize this advanced concept of opportunity cost, you need a mental model that creates a high rational bar for making any changes to your portfolio. This model can be called the tax-adjusted hurdle rate. It's a multi-step process for evaluating a potential switch between two investments. Step 1 is to establish a forward-looking return expectation for every single stock you currently own. This isn't about its past performance, it's about its future potential. Based on its current valuation, its growth prospects, and your analysis of the business, what do you realistically expect this stock to return on an annualized basis over the next 5 to 10 years? Write this number down for each holding. Let's say your analysis shows that your current holding, Company A, has an expected forward return of 12% per year. This is your baseline. Step 2 is to calculate your specific tax-adjusted hurdle. This is where most investors fail. They forget that selling a winning position comes with a cost. You must immediately pay capital gains tax. Let's say you have a $50,000 position in Company A, of which $20,000 is a capital gain. If your long-term capital gains tax rate is 20%, selling this position will trigger an immediate tax bill of $4,000, 20% of the $20,000 gain. This means you will only have $46,000 left to reinvest in the new opportunity. This tax friction is a significant performance drag. The new investment doesn't just have to be better. It has to be so much better that it can make up for this immediate 8% loss of capital, $4,000 divided by $50,000. Step 3 is to apply the hurdle. The new opportunity, Company B, must offer an expected forward return that is significantly higher than Company A's, nudged after sums accounting for the tax hit. A simple rule of thumb might be that Company B's expected return must be at least 30 to 50% greater than Company A's. So if Company A is expected to return 12%, you shouldn't even consider making the switch unless you believe Company B can reliably return 16 to 18% per year. This high hurdle does two things. First, it forces you to be very confident in your analysis of the new company. The potential reward must be large enough to justify the certain cost of taxes and the risk of being wrong. Second, it prevents the destructive habit of constantly tinkering with your portfolio. It stops you from selling a 12% return prospect to buy a 13% return prospect, a move that would almost certainly leave you worse off after taxes and transaction costs. The tax-adjusted hurdle rate is a discipline tool. It respects the power of compounding in your existing holdings and forces any new idea to be not just marginally better, but overwhelmingly superior before you disrupt a winning position. It is the practical application of Munger's advice. It's not that we have so many great ideas, we just wait for the no-brainers. The antithesis to this patient, opportunistic approach is the investor profile we call the chronic tinkerer. This individual mistakes activity for progress. Their portfolio management strategy is a whirlwind of motion, driven by a constant fear of missing out on the next big thing. The chronic tinkerer wakes up, turns on a financial news channel, and hears a pundit breathlessly describe a company that is set to revolutionize an industry. FOMO kicks in. They immediately log into their brokerage account, look at their portfolio of solid, steady compounding blue-chip stocks, and think, these are boring. They sell a perfectly good company like Procter & Gamble, a business that has been compounding wealth for generations, to chase the exciting new story stock. They don't run a tax-adjusted hurdle rate. They don't calculate the immediate tax drag. They are driven by narrative and emotion, not by math. A month later, they read a compelling article online about a different disruptive technology. The cycle repeats. They sell the previous hot stock, perhaps for a small gain or a small loss, and jump into the newest shiny object. Their portfolio becomes a revolving door. There is no long-term strategy, only a series of short-term tactical trades. They are constantly jumping from one lily pad to another, never staying long enough for the magic of compounding to take root. Each time they jump, they pay a toll. They pay a commission to their broker, and more importantly, they pay the capital gains taxman. They are systematically bleeding capital from their own portfolio through these frictional costs. The chronic tinkerer is not building wealth. They are engaging in a form of financial entertainment. It feels proactive and intelligent, but it is deeply destructive. They will often end a year with a flurry of trade confirmations but a portfolio that has barely beaten a simple index fund, or has even underperformed it, especially after taxes are accounted for. They have violated a core principle of successful investing, letting your winners run. Their portfolio never develops the monster winners that drive the vast majority of long-term returns, because any stock that starts to perform well is quickly sold to finance the next exciting idea. It is a strategy that guarantees mediocrity by constantly interrupting the very process that creates extraordinary wealth. The direct financial impact of this constant tinkering is a significant and quantifiable drag on a portfolio's long-term performance. The two main culprits, as we've discussed, are transaction costs and taxes, collectively known as frictional costs. Let's create a clear, quantified scenario to illustrate their corrosive power over time. Consider again two investors, Investor A, the patient owner, and Investor B, the chronic tinkerer. Both start with a $100,000 portfolio and are skilled enough to pick investments that generate a gross return of 12% per year over a 20-year period. Investor A, following the Buffett model, assembles her portfolio of wonderful businesses and holds them for the entire 20 years. Her costs are negligible. Her $100,000 compounds at 12% annually. After 20 years, her portfolio is worth $964,629. Now let's look at Investor B. He is just as smart at picking stocks, so his gross return is also 12%. However, he is a tinkerer. He sells and rebuys positions a few times a year, chasing new ideas. This activity generates two forms of drag. First, let's assume a very modest 1% per year in transaction costs, commissions, bid-ask spreads, etc. Second, by constantly realizing gains, he creates a tax drag. Let's assume his trading activity is frequent enough that it reduces his net return by an additional 1.5% per year. So Investor B's net annual return is not 12%, but 9.5%, 12% gross return, 1% transaction costs, 1.5% tax drag. The difference seems small, just 2.5 percentage points, but over 2 decades, the effect of this drag is devastating. Starting with the same $100,000, Investor B's portfolio, compounding at 9.5% per year, grows to only $614,159 after 20 years. The chronic tinkerer's activity cost him over $350,000. He sacrificed more than $250,000 for the illusion of being in control. Buffett views this concept with extreme seriousness. He thinks of the tax liability on his unrealized gains as an interest-free loan from the government. As long as he doesn't sell his long-held winners like Coca-Cola or American Express, he gets to keep that loan and invest it for Berkshire's benefit. The moment he sells, the loan comes due. His reluctance to sell is, therefore, a sophisticated strategy of capital management. He is maximizing the amount of money working for him at all times by keeping his, quote, silent partner, the taxman, at bay for as long as possible. The financial connection is direct and brutal. Every unnecessary transaction is a wealth transfer from your pocket to the pockets of your broker and the government, permanently reducing the capital base that you have available to compound. We now arrive at the third and final legitimate reason for selling a stock, and it is by far the trickiest and most rarely acted upon by Buffett himself, selling a wonderful business simply because its stock price has become absurdly overvalued. This is the ultimate test of an investor's discipline, as it requires selling something that is working beautifully and that everyone else is clamoring to buy. The masterclass for this principle was not a single transaction, but Buffett's stoic and widely mocked behavior during the height of the dot-com bubble in 1999 and early 2000. The late 1990s were a time of pure market mania. The narrative of the new economy had taken hold. Technology companies with no profits and often no revenue were coming to market and seeing their valuations soar to billions of dollars overnight. The old rules of investing were declared dead. Price-to-earnings ratios were irrelevant. Intrinsic value was a forgotten concept. All that mattered was eyeballs, clicks, and a business plan that included the .com suffix. In the middle of this frenzy stood Warren Buffett, a figure of seeming irrelevance. He famously refused to buy the high-flying tech and internet stocks, admitting simply, "I don't know how to value them." He was publicly ridiculed. Barron's ran a cover story in 1999 titled "What's Wrong, Warren?" asking if the Oracle of Omaha had lost his touch. He was called a dinosaur, a relic of an old, bygone era. But what is less discussed is what Buffett was doing during this period. He wasn't just abstaining from the buying frenzy, he was a disciplined, albeit reluctant, seller. He saw that the euphoria for technology stocks was creating a, quote, halo effect, lifting the valuations of all companies, including the solid, old-economy businesses he owned. Companies like Coca-Cola, Gillette, and American Express, which he had owned for years, were being bid up to prices that he considered nonsensical. In the late 90s, Coca-Cola's stock traded at nearly 50 times its earnings. To justify such a price, the company would have needed to grow at an impossible rate for decades to come. Buffett recognized that the price had become completely detached from the underlying business reality. The market was offering him not just a fair price or even a good price, but a ludicrously optimistic price for his shares. And so, with the same unemotional discipline he applies to all his decisions, he began to trim his positions. He was selling pieces of some of the best companies in the world, not because there was anything wrong with their business, but because the price offered was too good to refuse. His actions were the ultimate expression of his famous advice: be fearful when others are greedy. In the midst of the biggest party in stock market history, he was the one quietly selling his coat. The climax of this period came in July 1999, when he gave a speech at Sun Valley to a room full of technology executives and financiers. He calmly laid out the mathematical impossibility of the market's expectations, using historical data to show that for the current valuations to make sense, corporate profits would have to grow at a rate that would consume the entire GDP. The speech was met with polite indifference. Months later, in March of 2000, the bubble burst. The Nasdaq index, a proxy for the tech mania, began a catastrophic collapse, ultimately losing nearly 80% of its value. The new economy stocks were wiped out. And Warren Buffett, the dinosaur, was vindicated, his coffers full of the cash he had raised by selling his own wonderful companies at absurd prices to the euphoric masses. Buffett's ability to stand apart from the madness of the crowd is a testament to his mastery over two of the most powerful psychological forces in social finance: social proof and herd mentality. Social proof is the deep-seated human tendency to assume that the actions of others reflect the correct behavior in a given situation. If you walk into a building and see everyone running out screaming, you don't stop to analyze the situation. You run out screaming too. In financial markets, this translates to herd mentality. When everyone around you is getting rich buying internet stocks, the psychological pressure to join them is almost unbearable. Your neighbor, your brother-in-law, the cab driver, they're all bragging about their gains. Every fiber of your being tells you that they must know something you don't. To abstain, or even worse, to sell, feels like an act of social defiance. It feels like you are willingly choosing to be the fool who misses the party. Buffett is able to resist this pressure because he operates with what he calls an inner scorecard. His measure of success is not whether his actions align with the crowd or whether he is praised by the media. His only measure is whether he is acting rationally based on his own independent analysis of the facts. He would rather be right for the right reasons and be called a fool by the world than be wrong with the crowd. This inner scorecard is his shield against the immense psychological weight of social proof. The other cognitive bias at play during manias is overconfidence bias. As a bull market rages on, investors who have made money start to attribute their success to their own skill, rather than to the rising tide that is lifting all boats. They get a sense of invincibility. This overconfidence leads them to believe that the old rules no longer apply and that prices can only go up. The phrase, "it's different this time," is the anthem of every market bubble, and it is a direct symptom of rampant overconfidence. Buffett's antidote to this is a profound sense of humility. His famous refusal to invest in tech stocks was not an arrogant declaration that they were all bad businesses. It was a humble admission of his own limitations. "I don't understand them." He calls this sticking to his circle of competence. This discipline prevents him from getting swept up in manias for industries he can't confidently analyze and value. It keeps his feet firmly planted in the soil of business fundamentals while everyone else's heads are in the clouds of speculative fantasy. By combining a powerful inner scorecard with a humble respect for his own circle of competence, Buffett creates a psychological fortress that allows him to remain rational and disciplined, while the rest of the investing world descends into a frenzy of greed and collective delusion. To apply this level of discipline to your own decisions, you need a mental model that helps you define absurdly overvalued in a concrete way long before the mania takes hold. This model is the inversion of the margin of safety concept used for buying. We can call it the margin of absurdity. When you buy a stock, you apply a margin of safety. You calculate what you believe a business is worth, its intrinsic value, and you insist on buying it for a significant discount, say paying 50 cents for $1 of value. This protects you if your calculations are a bit off, or if the future isn't as rosy as you projected. The margin of absurdity is the selling equivalent. It dictates that you should only consider selling a great business due to valuation when the market is offering you a price that is not just above intrinsic value but absurdly, fantastically above it. You are looking for the moment when the market offers you $3 for what you know with high confidence is only worth $1. The first step in building this model is to calculate a ceiling value for each of your holdings. Based on an optimistic but still realistic projection of the company's future earnings growth, what is the highest justifiable price for this business? You can use a discounted cash flow model or a simple earnings multiple analysis. The point is not to find a precise number, but to establish a rational upper band for the company's value. Write this number down. Let's say you own a great company, and you calculate that under a very optimistic scenario, its intrinsic value over the next few years could reach $150 per share. This is your rational ceiling. Step 2 is to set your margin of absurdity trigger. This is a predetermined price level, set at a significant premium to your ceiling value, that will force you to seriously reevaluate your position. For instance, you might set the trigger at 200% of your optimistic ceiling value. In our example, that would be $300 per share, 200% of $150. This trigger is not an automatic sell order. It is a loud alarm bell that says, the market's enthusiasm has now entered the realm of the irrational. It is time to ignore the cheering crowd and re-examine the fundamentals with extreme skepticism. Step 3, when the trigger is hit, is to perform a reverse-engineered valuation. Ask yourself, for the current stock price of $300 to be justified, what would the company have to achieve? What growth rate would it need? What profit margins? For how many years? More often than not, during a mania, the math will reveal that the company would need to grow to the size of the entire planet's economy to justify the current price. This is the moment of clarity. It's the objective proof that the price is no longer connected to reality. This three-step process, calculating a rational ceiling, setting an absurd trigger, and then reverse engineering the price, provides a structured, unemotional framework for identifying and acting on market manias. It allows you to define absurd with numbers, not just feelings, and gives you the logical foundation to make the difficult decision to sell while everyone else is still buying. The investor who fails to use such a framework becomes the tragic character of every market cycle, the person who rides it to zero. This individual caught up in the euphoria of a bubble has no concept of intrinsic value. Their only metric is price momentum. As the stock they own goes from $10 to $50 to $200, their confidence swells. They are not a disciplined investor. They are a passenger on a rocket ship, and they believe it's headed for the moon. The stories from the dot-com crash are legendary. Day traders who had quit their jobs to trade internet stocks saw their paper fortunes swell to millions. They bought bigger houses and faster cars, convinced of their own genius. They had no margin of absurdity model. Their model was, the trend is your friend. They ignored the fact that the companies they owned had no earnings and no viable business model. They were riding a wave of pure sentiment. The same narrative played out in the cryptocurrency mania of 2017 and 2021. People invested their life savings into digital assets they did not understand, purely because the price was going up and their friends were getting rich. They told themselves, it's different this time. The 4 most expensive words in the English language. They confused a bull market for brains. Then, the inevitable happens. The bubble bursts. The psychology of the market flips on a dime from greed to fear. The rocket ship doesn't just stall. It reverses course and plummets back to Earth. The person who rode the wave all the way up is now faced with a brutal reality. Their overconfidence shatters. As the stock falls from $200 to $150, they tell themselves, it's just a healthy correction. At $100, fear begins to creep in, but loss aversion takes over. They can't bear to sell and lock in a 50% loss from the peak. At $50, they are paralyzed, haunted by the memory of their peak wealth. They hold on, hoping for a miracle. At $10, their massive paper gain has turned into a catastrophic real loss. They either finally capitulate and sell at the absolute bottom, or they simply hold the worthless shares as a permanent monument in their portfolio to the folly of chasing manias. This tragic arc is the direct result of having no valuation discipline. Without an anchor to intrinsic value, an investor is simply a cork tossed about on the waves of market emotion. They are slaves to the twin passions of greed and fear, a recipe for ultimate financial destruction. Selling a great company at an absurd price is difficult, but it is an act of supreme financial prudence that protects you from the devastating consequence of riding a bubble all the way back down. The direct financial mechanism at play during these cycles of boom and bust is the expansion and contraction of valuation multiples, most commonly the price-to-earnings, or PE ratio. An investor's total return from a stock comes from 2 primary sources: First, the growth of the underlying business's earnings, and second, the change in the PE multiple that the market is willing to pay for those earnings. A stable, wonderful business might grow its earnings by 10% a year and trade at a fair PE ratio of 20. If the PE ratio stays at 20, your annual return as a shareholder will be roughly 10%, in line with the business's growth. However, during a market mania, this relationship breaks down. The earnings of a company might still be growing at 10%, but investor euphoria can cause the PE multiple to expand dramatically. That PE of 20 might get bid up to 40, then 60, then even 100 or more. This multiple expansion is what creates the parabolic, rocket ship stock charts seen during bubbles. Buffett's decision to sell during these periods is a disciplined move to harvest this unsustainable multiple expansion. He knows the underlying business hasn't suddenly become 5 times better, but the market is temporarily willing to pay 5 times more for it. He is selling the euphoria. The inevitable and brutal aftermath of every bubble is PE contraction. When the narrative breaks and fear replaces greed, those sky-high multiples collapse back to, and often far below, their historical averages. This is where the wealth destruction happens. Let's look at the math. Imagine a company earning $2 per share. During a mania, its stock is bid up to a PE of 100, resulting in a stock price of $200. You, the euphoric investor, buy it at the top. The next year, the bubble bursts. The company actually has a great year and grows its earnings by 20% to $2.40 per share. The business is doing well, but the market sentiment has soured, and the PE multiple contracts from 100 back down to a more rational 20. The new stock price is now $2.40 in earnings multiplied by a PE of 20, which equals $48. Despite the underlying business growing by an impressive 20%, your stock has plummeted from $200 to $48, a loss of 76%. You lost a fortune not because the business failed, but because you paid a euphoric price for it. Selling at the peak of the PE expansion is how you avoid this devastating financial outcome. It is the recognition that a stock price can become a speculative instrument completely detached from the business it represents. A disciplined investor sells that speculative instrument to the speculators and keeps the cash, waiting for the day when prices once again reflect reality. We have now deconstructed the 3 pillars of rational selling, the legitimate exceptions to the hold forever rule. But to truly solidify this philosophy, we must confront the 2 great sins of portfolio management that this entire framework is designed to prevent: the sin of selling your winners too early, and the sin of holding your losers too long. Warren Buffett, despite his legendary success, is the perfect guide here, as he has been brutally honest about his own massive errors in both respects. His most famous self-admitted mistake of premature selling was his early investment in the Walt Disney Company. In 1966, Buffett met Walt Disney himself, was deeply impressed by the man and his vision, and invested $4 million of his partnership's money into the company's stock. This was a significant position, representing about 5% of Disney's market cap at the time. He saw the incredible, untapped value of the company's film library and brand. Just 1 year later, in 1967, the stock had risen by more than 50%. Buffett, still operating more in the cigar butt style of his early career, saw a quick, handsome profit and sold the entire position for a gain of over $2 million. He felt clever. He had made a lot of money in a short time. But in his later shareholder letters, he would refer to this as a monumental error. He didn't sell because Disney's moat was eroding or because he had a dramatically better opportunity. He sold simply to lock in a gain. He cut his flowers. That $4 million investment, had he simply held on to it, would be worth billions of dollars today. It was a multi-thousand bagger that he traded for a mere 50% profit. This mistake haunted him and was a crucial lesson in the immense cost of selling a truly wonderful business too early. On the other side of the ledger is the sin of holding a loser for too long, a lesson he learned from the very company that would become his famous vehicle, Berkshire Hathaway. When Buffett first bought into Berkshire in the early 1960s, it was a struggling New England textile manufacturer. It was a classic cigar butt investment, a terrible business trading at a statistically cheap price. He gained control of the company and, out of a combination of stubbornness and a misguided sense of loyalty to the failing business, he continued to pour money into the textile operations for 2 decades, long after it was clear that the industry was in terminal decline due to foreign competition. He was watering the weeds. He later calculated that this dumb decision, this emotional attachment to a fundamentally broken business, had cost him and his shareholders about $200 billion in lost opportunity cost. That capital, trapped for years in the terrible textile business, could have been compounding in the wonderful businesses he was beginning to discover. These 2 formative mistakes, selling Disney too soon and holding the Berkshire textile mills too long, are the bookends of his selling philosophy. They taught him that the most important job of an investor is to identify the truly great businesses and then have the fortitude to do nothing, while simultaneously having the discipline to ruthlessly exit the deteriorating ones, regardless of emotional attachment or past commitment. The twin sins of selling winners and holding losers are not random quirks of behavior, they are the direct, predictable outcome of a powerful cognitive bias known as the disposition effect. First identified by economists Hersh Shefrin and Meir Statman, the disposition effect is the documented, irrational tendency of investors to sell assets that have increased in value, while keeping assets that have dropped in value. The psychological engine behind this phenomenon is Daniel Kahneman and Amos Tversky's groundbreaking work on prospect theory, specifically the concept of loss aversion. Their research proved that, for most humans, the psychological pain of a loss is roughly twice as powerful as the pleasure of an equivalent gain. Losing $100 feels twice as bad as finding $100 feels good. This asymmetry dictates our financial behavior. When a stock you own has gone up, it represents an unrealized gain. Selling it turns that paper gain into real cash, triggering a pleasant, ego-boosting hit of pleasure. You feel smart and successful. You have locked in a win. Your brain, seeking this pleasure and seeking to avoid the future pain of that gain possibly disappearing, urges you to sell. Conversely, when a stock you own has gone down, it represents an unrealized loss. As long as you don't sell, the loss is just theoretical. You can tell yourself, I haven't really lost any money until I sell. The act of selling would crystallize the loss, making it real and forcing you to confront the painful admission that you made a mistake. Your brain, wired with powerful loss aversion, will do anything to avoid this pain. It urges you to hold on, to wait for it to get back to even, a point at which you could sell without the emotional sting of a realized loss. The disposition effect, therefore, turns sound investment strategy completely on its head. A rational investor should hold on to their best-performing assets, their winners, as these are clearly the companies with the strongest fundamentals and momentum. They should be critically re-evaluating or selling their worst-performing assets, their losers, as these are the most likely to have deteriorating business fundamentals. But loss aversion forces the average person to do the exact opposite. It creates a portfolio where the flowers are constantly being cut and the weeds are being carefully tended. It is a perfect, psychologically driven recipe for mediocrity, and overcoming it is one of the single greatest challenges in the journey to becoming a successful long-term investor. To systematically dismantle the disposition effect and escape the trap of loss aversion, you need a mental model that forces a completely neutral, forward-looking evaluation of your portfolio. The most powerful tool for this is the zero-based portfolio audit. It's a simple but profound thought experiment that you should conduct at least once a year. The process begins with a radical, imaginative step. Imagine that overnight, your entire investment portfolio was automatically liquidated, and all the proceeds, completely tax-free, were deposited into your checking account as cash. You wake up with no stock positions, only a single lump sum of money. Your emotional baggage, your purchase prices, your feelings about past gains or losses has been wiped clean. You have a blank slate. Now, for step 2, take out a list of the stocks you used to own just yesterday. Look at each one. With the pure, unencumbered cash you now have in the bank, ask yourself a simple, brutal question for each company on that list. Knowing what I know today, and at today's market price, would I buy this business? Be ruthlessly honest. If the answer for a particular stock is an immediate, enthusiastic yes, then that stock earns its right to remain in your ideal rebuilt portfolio. It is a true conviction holding, validated not by history, but by a fresh commitment. But if your answer is no, or even a hesitant maybe, you have identified a problem. Any stock that you would not be willing to buy again today is a clear candidate for sale. The only reason you are still holding it in your real-life portfolio is due to inertia, emotional attachment, or the disposition effect. You are clinging to a past decision, not making a new, rational one. This mental exercise is so powerful because it completely neutralizes the cognitive biases that anchor you to your past mistakes. The sunk cost of your original purchase price becomes irrelevant. The pain of realizing a loss is reframed as a simple decision not to re-enter a bad position. The reluctance to sell a winner is replaced by the positive, proactive question: is this still one of the absolute best places for my capital to be for the future? The zero-based portfolio audit forces you to become a forward-looking capital allocator, not a backward-looking curator of past bets. It compels you to re-justify every single holding every single year based solely on its future prospects versus all other available opportunities. It is the ultimate antidote to the sin of watering your weeds. When an investor succumbs to the disposition effect year after year, their portfolio inevitably morphs into a sad and inefficient collection of assets that can be described as the gardener of weeds. Let's paint a picture of this all-too-common portfolio. At the top, you might see 1 or 2 positions with small green numbers next to them, gains of 15% or 20%. These are the flowers. The gardener of weeds looks at these with anxiety. They are a source of temptation. The urge to take the money and run is overwhelming. They see these winners not as the powerful engines that could drive their future wealth, but as risky bets that might reverse course. So, they sell them, booking a small, satisfying profit and reducing their portfolio's potential for massive long-term growth. Below these few small winners is a much longer list of positions, all glowing with an angry red. These are the weeds. There might be a biotech stock bought on a hot tip that's down 50%. There might be a former blue-chip company in a dying industry that's down 40%. There's an IPO that fizzled and is down 70%. The gardener of weeds looks at this section not with a cold, analytical eye, but with a sense of hopeful stubbornness. Their capital, their precious financial soil, is trapped in these deteriorating businesses. But they cannot bring themselves to sell. "I'll just wait for it to get back to even," they mutter, a mantra that serves as a psychological balm but is a financially disastrous strategy. The result is a portfolio that is mathematically engineered for underperformance. The capital is concentrated in the worst ideas, while the best ideas are systematically eliminated. It's like a sports team manager who benches his star players after they score a goal and gives more playing time to the players who keep fumbling the ball. It makes no logical sense, yet it is the default behavior for millions of untrained investors. This is the ultimate path of the 99%. It is a portfolio defined by the ghosts of past prices, not the promise of future growth. It is a garden where the weeds are allowed to choke out the sunlight, ensuring that no magnificent oak trees of wealth can ever truly take root and grow. The ultimate financial and mathematical reason why this gardener of weeds strategy is so catastrophic lies in a concept from statistics known as the power law distribution, often referred to as the 80-20ths rule. In the context of long-term investing, the power law dictates that the vast majority of a portfolio's returns, often 80% or more, will be generated by a very small number of monster-winning stocks. Your potential loss on any single stock is capped at 100%. If you invest $10,000, the most you can lose is $10,000. But your potential gain is theoretically infinite. A single great investment can return 10, 50, or even 100 times your initial capital, a 10,000% gain. The entire game of long-term investing is therefore not about avoiding all losers, which is impossible, but about ensuring that you find and, most critically, hold on to these rare portfolio-defining winners. Let's visualize this. Imagine a 30-year investment portfolio with 20 stocks. Over that time, perhaps 10 of them are duds, going to zero or breaking even. Maybe another 8 perform reasonably well, generating modest market-like returns. But 1 or 2 of them are spectacular successes. One is an Amazon, a Microsoft, or Nvidia. These 1 or 2 stocks don't just go up 50%, they go up 5,000% or 10,000%. Their explosive growth will be so powerful that it will single-handedly compensate for all the losers and mediocres, and will go on to produce the lion's share of the portfolio's total wealth. The sin of cutting the flowers, driven by the disposition effect, is a direct assault on the power law. When you sell a future monster winner after it has only doubled or tripled, you are severing your connection to the very engine of wealth creation. You are making a catastrophic financial error that may cost you millions in future gains, all for the fleeting satisfaction of a small, realized profit. The math is undeniable. The secret to building extraordinary wealth is not to have a portfolio of 20 modest winners. It is to have a portfolio where a few spectacular winners are given the decades they need to compound to their full, magnificent potential. Buffett's "our favorite holding period is forever" is not just a philosophy, it is a profound understanding of this mathematical reality. He knows that selling a Coca-Cola or an American Express, unless one of the 3 exceptions is met, is an act of financial self-sabotage. It's willingly chopping the head off the power law distribution in your own portfolio. The entire framework of his reluctant selling discipline is designed to protect him from making that single, most costly error in all of investing. You have just been given the keys to the final, most crucial part of the investment machine, the selling discipline of Warren Buffett. You have moved beyond the amateur's game of merely picking stocks and have entered the professional's realm of true portfolio management. You now possess the mental framework to hold your winners, to cut your losers for the right reasons, and to let the unstoppable force of compounding work its magic for you over decades. But this discipline is built on a foundation. It's connected to how he finds great businesses in the first place, how he values them, and how he constructs a portfolio that is psychologically built to last. Mastering the when to sell is powerful, but it's only one node in a network of interconnected mental models. The video on your screen right now is the next part of that network. It's the link that connects this selling philosophy to the initial act of buying. It's the other half of the equation, designed to build a portfolio so strong you'll rarely need to use the tools you've learned today. Most people will stop here, satisfied with one piece of the puzzle, but you're not most people. The journey to true financial discipline isn't about collecting random tips. It's about building a complete mental arsenal. Complete your arsenal. Continue the ascent. Click the video.